All right, let's talk Vital Farms. We're diving into their Q2 earnings call, and let me tell you, it was impressive. For years, this company has been bumping up against supply constraints, and these latest results, well, they might just signal a major turning point.
So this is really the big question we need to answer. For the longest time, the story with Vital Farms wasn't about a lack of demand. It was all about whether they could actually get their hands on enough eggs to meet that demand. This quarter, though, it feels like they're finally getting out in front of it.
Okay, first things first, let's look at the headline numbers because they send a really loud and clear message to Wall Street. And we're not talking about a small beat here. This was a massive outperformance pretty much everywhere you look. So check this out. Earnings per share came in at 36 cents. Now that might not sound like a huge number on its own, but the analysts, they were only expecting 27 cents. That's a beat of over 30%, a really decisive start to what turned out to be a blowout quarter. And the revenue side of the story is just as good, if not better. Year-over-year growth of more than 25%. That blew past estimates by about $15 million. And you know, the really crucial part here is that this wasn't just about higher prices. It was driven by some seriously strong volume growth, too. And when you lay it all out like this, you really see the whole picture. I mean, it doesn't matter if you're looking at revenue, EPS, or their adjusted EBITDA, Vital Farms just cleared the bar that analysts had set, and they did it with plenty of room to spare. This is exactly the kind of clean sweep that gets investors excited. So, how did the market react? Pretty much immediately and very positively. The stock popped almost 7% in pre-market trading right after the numbers came out. You could tell investors didn't just love the beat, they loved the confidence the company showed by raising its guidance for the whole year. Okay, so that's the what. Now let's get into the why. How are they pulling this off and what does it mean for their long-term strategy? Because management isn't just taking a victory lap here. They are actively laying the groundwork to become a billion-dollar company.
The whole strategy really comes down to what you could call a capacity-to-demand flywheel. Think about it. For years, more people wanted their eggs than they could supply. So now they're pouring money into building more capacity. That new capacity lets them finally meet all that pent-up demand, which drives more revenue, which then gives them the cash to, you guessed it, fund even more expansion. It's a classic, beautiful growth loop.
And here's exactly how they're making it happen. They've expanded their network to over 500 family farms. They are hitting the gas on capital spending in a big way. They're building out new production lines, and the whole point of all of this, to finally capture all that unmet demand and just let volume growth take off. Now, this is what I find really fascinating. Just look at the scale of this acceleration. They basically doubled their capital spending plans for the year. And why? Because they made the call to build 2 new production lines at their facility in Seymour, Indiana, at the same time instead of one after the other. I mean, that is a huge vote of confidence in where they see demand going. And you don't have to take my word for it. The CEO laid it out pretty clearly on the call. He said, this is all about getting ahead of the demand curve after playing catch-up for so long. The key takeaway here is they're being aggressive, and they're using their super strong debt-free balance sheet to lock in that future growth right now.
Okay, but it can't all be sunshine and roses, right? For a balanced view, we have to talk about the risks. There are some potential headwinds out there that could put some pressure on their profit margins, even while that top-line revenue number is soaring.
So this is the real tension for investors. On one hand, the bull case is crystal clear. Guidance is up, they're expanding like crazy, and supply isn't a problem anymore. But the bear case points to things like tariffs, more discounts and promotions in the second half of the year, and higher marketing costs. Now, what's really important is that management said they've already baked these pressures into their new, higher guidance. That's a huge deal. It gives them a nice safety net. Still, you'll want to keep an eye on those headwinds, especially tariffs, to make sure they don't get worse than expected.
So, what do we have? We've got a massive earnings beat, a super clear strategy for growth, and a few risks that seem pretty manageable. Where does that leave us? Let's put it all together and give you our take on what to expect for this stock. Look, this quarter really felt like an inflection point. The whole story has shifted from can they find enough supply to how fast can they grow? And that change sets up a really interesting dynamic for the rest of the year. So here's our call. We think revenue growth is going to keep accelerating as all that new capacity comes online. We're predicting earnings per share will hold pretty steady as the company reinvests in growth and absorbs some of those margin costs we talked about. And as for the stock price, we see a clear runway to the high 40s over the next 6 months as the market fully gets on board with this new unconstrained growth story. So, putting it all together, our rating on Vital Farms is outperform. The execution this quarter was fantastic. They're deploying capital aggressively and with confidence, and they have a clear path to capturing a ton of unmet demand. They are putting that balance sheet to work, and we think the market is going to reward that clarity and execution.
And, as always, please remember this analysis is for informational purposes only. It is not financial advice. Be sure to do your own research before making any investment decisions.